We used to think inflation had a formula. Too much money chasing too few goods. Raise rates, cut spending, shrink demand, and it would fade. But in 2025, that logic feels like solving wildfire with a watering can. Welcome to FluxFolio Finance. This isn't just a story of prices going up. It's the story of a global economy where supply chains fracture, wars flare, labor vanishes, and money no longer listens to math. This is inflation, but stranger. Once upon a time, inflation was temporary. Or so we thought. In 2021, it surged: COVID disruption, stimulus overload, supply bottlenecks. But by 2022, central banks were confident. Transitory, they said. Then came 2023. Then 2024. And now, halfway through 2025, inflation isn't just still here, it's mutated. Wages are sticky. Food costs haven't budged. Services inflation, the invisible kind you feel in healthcare, insurance, education, keeps rising. Even as energy cools, rents go up. Even as tech deflates, essentials inflate. It's not uniform. It's not logical. It's fractured inflation. And here's the paradox: growth is slowing. But prices aren't. GDP forecasts are being trimmed across Europe, Asia, and even the US. China faces youth unemployment and property deflation. Germany flirts with recession. Even Wall Street whispers about stagflation again. So why haven't prices dropped? Because we've entered a world where inflation isn't just demand-driven. It's structural. Embedded in policy, demographics, climate, and war. Let's start with demographics. For decades, global growth relied on a surplus of young workers. China, India, Southeast Asia. Factories thrived. Costs stayed low. Wages were suppressed. Inflation was tame. But now? China is aging. Birth rates are collapsing across developed and developing nations alike. Labor shortages are everywhere, from trucking to teaching, nursing to manufacturing. In the US, there are 9.8 million job openings, but only 6.5 million available workers. Europe faces a retirement wave. Japan is running out of people entirely. When labor is scarce, wages rise. When wages rise, services get expensive. And when services inflate, the central bank toolkit grows blunt. You can't print workers. You can't raise rates to create caregivers or truck drivers. This is inflation from within. From age, from time. Then comes deglobalization. Remember the age of offshoring? China builds it. Mexico ships it. America consumes it. That model worked for decades until it cracked. First from COVID. Then from war. Then from politics. Now, supply chains are coming home. Or being rerouted. Or doubled, just in case. This shift isn't cheap. Redundant logistics. Regional production. Tariffs. Sanctions. Export bans. All of these are costs, baked into the new normal. Deglobalization means less efficiency. Less efficiency means higher costs. Higher costs mean persistent inflation. And then, energy. Even as oil prices retreat from their 2022 peaks, the transition to clean energy is inflationary. Why? Because it requires investment. Batteries, grids, charging stations, rare earth mining. The shift from fossil to green isn't deflationary, it's expensive, front-loaded, and slow. Yes, solar is cheap. Yes, wind is abundant. But the metals, the transport, the land, the politics? They all raise prices in the short term. We're trying to run a marathon, barefoot, across volcanic terrain. And we're surprised our feet are burning. Meanwhile, central banks are stuck. Raise rates too much, and growth dies. Cut them too early, and inflation roars back. Do nothing? Markets panic. It's a hall of mirrors. The Fed raises rates, and services inflation barely moves. The ECB tightens, and European households grow poorer, but rents keep rising. Japan, once deflationary, now sees imported inflation from energy and a weak yen. Emerging markets? Caught between weak currencies and imported food inflation. The toolbox is emptying. Because this inflation isn't mechanical. It's psychological. Behavioral. Sticky like honey, slow to rise, slower to fall. Let's talk about portfolios. Because inflation isn't just a line on a chart. It's a wrecking ball, smashing 60/40ths portfolios, bond logic, retirement models, and the illusion of safety. In the old world, inflation was cyclical. So you bought bonds when it rose, tech when it fell, cash when rates were high. You had rules. Back-tested strategies. Confidence. But this is inflation with no rhythm. Energy up. Tech up. Gold up. Bonds down. Then sideways. Then up again. Volatility has become the new alpha. And consistency? A casualty. Let's unpack the damage. Bonds, once the ballast of every pension fund, are now chaos. In 2024, U.S. Treasuries lost trust. Not because of default, but because of dilution. Too much issuance. Too little demand. Foreign buyers pulled back. Yields spiked. And suddenly, risk-free assets weren't free of risk. Even the mighty U.S. government had to sweeten the pot, issuing 100-year bonds, talking about yield curve control, considering liquidity backstops. All while inflation refused to go gently into the night. Meanwhile, stocks live in two worlds. Tech? Up and to the right. Automation, platforms, chips. They thrive even with rates above 5%. Why? Because they scale. Because they create, not consume, labor. Because they write the future. But the rest? Retail. Real estate. Banks. Commodities. They're caught in the squeeze. Higher input costs. Higher wages. Slowing demand. Tighter credit. It's a tale of two economies. The deflationary tech engine. And the inflationary service grind. And investors must dance between them, fast. Then there's gold. Once dismissed as barbaric, now it glows again. Because gold doesn't care about yield. It doesn't respond to GDP. It listens to fear. To trust. And trust is leaking. Into gold. Into Bitcoin. Into land, art, wine, and weirdness. Because in an age where nothing is stable, tangibility becomes luxury. What does all this mean? It means your risk model is obsolete. Your portfolio map? Burn it. Inflation isn't just a number. It's a shift in belief. Belief in central banks. Belief in fiat. Belief in globalization. Belief in peace. When those beliefs wobble, capital runs. Not toward yield. But toward conviction. What you trust, you keep. Everything else? priced to exit. And what of politics? Inflation kills governments. It eats wages. It inflames populism. It turns technocrats into villains. And 2025 is an election year in the US, a pivot year for China, and a pressure year for Europe. Nobody wants 6% CPI. Nobody wants $5 gas. Nobody wants breadlines, literal or metaphorical. So what do? They intervene. Subsidies. Price caps. Wage controls. Currency manipulation. But these are salt on sand. They change the optics, not the structure. The structure is broken. And the public knows it. So what's the way out? There isn't one. Not yet. Because we're not fighting inflation anymore. We're learning to live with it. Like Japan did with deflation. Like Argentina did with volatility. Like empires did with droughts. We adapt. We hedge. We get sharper, faster, less romantic. This is not a crisis to be solved. It's a climate to survive. Thank you for watching FluxFolio Finance. If this helped reframe the inflation you feel, but couldn't name, give it a like. Subscribe for deep dives that peel back the surface and reveal the mechanisms underneath. And drop a comment. Are we at the start of a new normal, or clinging to an old one? Until next time, stay smart, stay skeptical, and stay sovereign.